What if the CRA, the very agency that collects your taxes, has quietly built legal strategies into the Canadian tax code that allow retirees to pay significantly less tax every single year, and the vast majority of Canadian retirees are not using a single one of them? Not because they are ineligible, not because they do not qualify, simply because nobody ever told them these strategies exist. Think about how much money that represents over a 5, 10, or 15-year retirement. Thousands of dollars. Tens of thousands of dollars for some people. Money that belongs to you, that you are legally entitled to keep, that is instead going to the government every April because you did not know you had another option. Today, that changes. I am going to walk you through 5 powerful, completely legal, CRA-approved tax strategies specifically designed for Canadian retirees. And I am going to spend extra time on number 3, because in all the years we have been covering this topic, number 3 is the one that genuinely stops people in their tracks. They have never heard of it. Their accountants have never mentioned it. And yet it is sitting right there in the Income Tax Act, available to anyone who qualifies. Stay with me until the end. This video could be worth more to your retirement than anything else you watch this year. Welcome, everyone. If you are joining us for the first time today, this is Pension Facts Canada, the channel where we make Canadian tax law, pension rules, and retirement finance genuinely understandable for everyday people. We are not here to impress you with jargon. We are here to put real, useful, actionable information in your hands. Information that can protect your income, reduce your tax bill, and help you enjoy the retirement you worked your entire life to reach. If that sounds like something you need, subscribe right now and turn on notifications because we publish this kind of content every single week. Now let us get into the 5 strategies, starting from the top. The first strategy is pension income splitting, and while some of you may have heard of this one, you would be shocked by how many retired couples are still not using it, or are using it incorrectly and leaving money behind. Pension income splitting allows a Canadian retiree to allocate up to 50% of eligible pension income to their spouse or common law partner for tax purposes. What this means in practice is powerful. If one spouse is receiving a large workplace pension, RRIF withdrawals, or annuity income, and the other spouse has little or no income, the higher earning spouse is likely sitting in a much higher marginal tax bracket than necessary. By splitting up to half of that eligible pension income with the lower earning spouse on their tax returns, the couple can dramatically reduce the total amount of tax they pay as a household. The income does not actually have to be transferred between bank accounts. This is a tax return election made using Form T-1232. And the savings can be significant. For a couple where one spouse earns $40,000 in pension income and the other earns almost nothing, splitting $20,000 to the lower earning spouse could reduce the household tax bill by several $1,000s in a single year. If you are married or in a common law relationship and you have not been doing this, talk to your accountant before you file another return. The second strategy is the pension income tax credit. And this one is so straightforward that it is almost embarrassing how many retirees miss it. The federal pension income tax credit allows eligible retirees to claim a non-refundable tax credit on the first $2,000 of eligible pension income they receive each year. At the federal level alone, this credit reduces your tax bill by up to $300 annually. And most provinces offer a matching or similar provincial pension income credit on top of that, pushing the combined savings higher. Now, $300 might not sound like a life-changing amount on its own, but here is why it matters more than it appears. First, if you are not currently receiving any eligible pension income, meaning you do not have a workplace pension or annuity, you can actually create eligible pension income by converting even a small portion of your RRSP into a REIF before age 71 and taking a withdrawal from it. A $2,000 RRIF withdrawal qualifies as eligible pension income if you are 65 or older, which means you can manufacture this credit even if you have no traditional pension at all. Second, when combined with pension income splitting, both spouses can each claim this credit, doubling the household savings. This is the kind of layering that turns small strategies into genuinely meaningful tax reductions year after year. Now, before we get to number 3, the one I promised would surprise you, I want to plant something in your mind and let it sit there for just a moment. The next strategy we are about to discuss is one that has been available to Canadian retirees for years. It is fully sanctioned by the CRA. It is used by a very small percentage of retirees who happen to know about it. And once you hear it, you are going to wonder why you were never told. Keep that anticipation right where it is. We are going to get there in just 60 seconds. But first, let me make sure you understand the foundation, because number 3 only works best when you already understand what we just covered. Stay with me. Number 3, the age amount tax credit combined with a strategic RRSP or RRIF drawdown plan to stay below the income clawback threshold. I know that sounds technical, so let me break it down into plain language, because the concept is actually elegant once you see it clearly. The age amount is a federal non-refundable tax credit available to Canadians who are 65 or older at the end of the tax year. In 2026, the base federal age amount is over $8,000, meaning you can claim a credit worth approximately 15% of that amount, reducing your federal tax bill by over $1,200 per year, simply for being 65 or older. But, and this is the part almost nobody talks about, the age amount begins to be reduced once your net income exceeds approximately $42,000, and it disappears entirely once your income reaches approximately $98,000. This is the clawback. And here is the insight that changes everything for many retirees. If your annual income sits just slightly above the reduction threshold, say $45,000 or $48,000, you may be voluntarily losing hundreds of dollars of this credit every year without realizing it. And the reason your income is slightly too high might be something as controllable as the size of your annual RRIF withdrawal. Many retirees take RRIF withdrawals that are larger than the mandatory minimum without any particular reason, habit, convenience, or simply because nobody has suggested an alternative. By reducing those withdrawals to closer to the mandatory minimum, keeping net income below the age amount reduction threshold, you can recapture this credit fully and reduce your tax bill by over $1,000 per year. When you combine that with pension income splitting, the pension income tax credit, and strategic TFSA withdrawals to replace the income you are no longer pulling from your RRIF, the result is a retirement income plan that delivers the same monthly cash in your pocket with a dramatically lower annual tax bill. This is the strategy that most retirees have never been told about. This is number 3, and now you know it. Here is the pattern interrupt, because I want you to pause for a second and appreciate what just happened. We are halfway through this video, and you have already been handed 3 strategies that, combined, could save a Canadian retiree anywhere from $2,000 to $8,000 per year in tax. Every year, you check for the entire length of your retirement. That is not a small number. That is real money. Money for travel, for your grandchildren, for your health, for your comfort. And we still have 2 more to go. So let us keep moving. The 4th strategy is the medical expense tax credit. And the reason it appears on this list is not because it is obscure. It is because most retirees dramatically underestimate how many expenses qualify and how much of a credit they can actually claim. The federal medical expense tax credit allows you to claim eligible medical expenses that exceed the lesser of 3% of your net income or a set dollar threshold. In 2026, that threshold is around $2,700. What qualifies as an eligible medical expense is broader than most people assume. Prescription medications obviously qualify, but so do eligible dental expenses, vision care, hearing aids and batteries, attendant care costs, premiums paid to private health insurance plans, the cost of a private nurse, renovations made to a home to accommodate a disability, such as wheelchair ramps, walk-in bathtubs, or grab bars, and in many cases the cost of a medical device prescribed by a doctor. For retirees who are managing chronic conditions, paying out of pocket for dental work, or supporting a spouse who requires additional care, the eligible expenses can add up to a very significant credit. And here's the strategic piece. You are allowed to claim medical expenses for any 12-month period ending in the tax year, not just the calendar year. This means you can choose the 12-month window that maximizes your eligible expenses. If you had a particularly high expense period that spans 2 calendar years, you can select the 12-month window that captures the most expenses and generates the largest credit. Most tax software does not automatically optimize this window for you. You have to know to look for it. The fifth and final strategy is charitable donation tax credits combined with a planned giving approach using in-kind securities or RRSP assets. This one is for retirees who are charitably inclined and who want to be strategic about how they give. When you donate publicly traded securities, stocks, ETFs, mutual fund units, directly to a registered charity in Canada rather than selling them first and donating the cash, two things happen simultaneously. You completely eliminate the capital gains tax on the accrued gain of those securities, and you receive a donation tax receipt for the full fair market value of the securities at the time of the gift. This is one of the most tax-efficient ways to give in the entire Canadian tax system. For a retiree who has held an investment that has grown significantly, say shares of a company or an ETF that has tripled in value since purchase, the capital gains tax on selling those shares could be substantial. By gifting them directly to charity instead, that capital gains tax disappears entirely. The charity receives the full value, and you receive a donation credit worth a significant percentage of the gift value that can be applied against your tax bill. Additionally, for retirees who wish to support a charity in a major way as part of their estate plan, there are strategies involving naming a charity as a direct beneficiary of RRSP or RRIF assets that can generate donation credits in the year of death and significantly reduce the final tax bill of the estate. Planned giving of this nature can save estates tens of thousands of dollars in tax, while supporting causes that matter deeply to the retiree. So let us bring all five together, because the real power here is not in any single strategy. It is in the combination: pension income splitting to equalize income between spouses and reduce marginal tax rates. The pension income tax credit to claim up to $2,000 of eligible income and generate a federal and provincial credit. Strategic RRIF drawdowns calibrated to stay below the age amount clawback threshold and maximize that credit. The medical expense tax credit claimed over the optimal 12-month window. And charitable giving through in-kind securities to eliminate capital gains and generate donation credits. Used together, these five strategies form a retirement tax plan that is dramatically more efficient than simply filing your return with whatever income came in and hoping for the best. And every single one of them is completely legal, fully endorsed by the CRA, and available to Canadian retirees right now. The question is not whether these strategies work. They do. The question is whether you knew about them before today, and whether you are going to do something with this information now that you do. Because information without action is just entertainment, and you did not stay with us through this entire video just to be entertained. You stayed because you recognize that this information matters for your financial life. And you are right. It does. That is exactly why Pension Facts Canada is here. To give you the kind of information that your accountant might mention if you specifically ask the right questions, but that nobody volunteers at tax time because the assumption is that you already know. You deserve to know. Every Canadian retiree deserves to know. And if you got value from today's video, if even one of these five strategies is something you are going to look into further, please do three things right now. Hit the like button because it helps more Canadian retirees find this channel and access this information. Subscribe to Pension Facts Canada and turn on the notification bell because we publish content like this every single week and you do not want to miss what is coming next. And leave a comment below. Tell me which of the five strategies surprised you most. Was it number 3? Was it the in-kind charitable donation strategy? Was it the medical expense 12-month window? Tell me in the comments. I read every single one, and your responses help shape the content we create for you going forward. Thank you for spending your time with us today. This is Pension Facts Canada, and we will see you in the next video. Your retirement should be everything you worked for, and with the right knowledge, it can be.